Question 1. An individual purchasing a new life insurance policy in Alabama must be given a free look period. How long is this period for a standard life insurance policy? A. 5 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. The free look period allows policyholders to return a newly purchased life insurance policy for a full refund of premiums paid, typically because they changed their mind or found a better option. In Alabama, the standard free look period for a life insurance policy is 10 days from the date the policy is delivered. This provision is designed to protect consumers by giving them time to review the policy terms and ensure it meets their needs without financial penalty. For example, if a policy is delivered on June 1st, the policyholder has until the end of June 10th to return it for a full refund. Always inform clients about this crucial right during policy delivery. Question 2. All of the following are considered non-forfeiture options in a whole life insurance policy, except A. Cash surrender value. B. Extended term. C. Reduced paid up. D. Automatic premium loan. Answer: D. Automatic premium loan. Non-forfeiture options are choices available to a policy owner who decides to surrender a whole life policy that has accumulated cash value, allowing them to retain some value from the policy. The three primary non-forfeiture options are cash surrender value, taking the accumulated cash; extended term, using cash value to buy a single premium term policy for the same death benefit; and reduced paid up, using cash value to buy a single premium whole life policy for a reduced death benefit. The automatic premium loan is a policy loan feature, not a non-forfeiture option, designed to prevent a policy from lapsing by automatically borrowing from the cash value to pay an overdue premium. Remember, non-forfeiture means not losing value if you stop paying premiums. Question 3. What is the primary purpose of the Medical Information Bureau, MIB? A. To rate and classify insurance applicants for underwriting purposes. B. To detect and deter fraud by collecting and sharing medical data among insurers. C. To provide medical treatment histories to applicants upon request. D. To assist state departments of insurance in monitoring underwriting practices. Answer: B. To detect and deter fraud by collecting and sharing medical data among insurers. The Medical Information Bureau, MIB, is a non-profit association that operates an information exchange for life and health insurers. Its primary purpose is to help detect and deter fraud by collecting and sharing coded medical information about applicants, which helps insurers verify the accuracy of applications and identify significant errors or misrepresentations. For instance, if an applicant fails to disclose a serious medical condition on their application, the MIB report might reveal it if they previously applied for insurance elsewhere. This system helps prevent individuals from obtaining coverage at rates lower than their true risk warrants. Question 4. In Alabama, a life insurance policy's incontestability clause generally prevents the insurer from denying a claim based on misrepresentations in the application after the policy has been in force for a specific period. What is this period? A. 6 months. B. 1 year. C. 2 years. D. 3 years. Answer: C. 2 years. The incontestability clause is a vital policy provision designed to protect the policyholder and beneficiaries from an insurer denying a claim based on misrepresentations in the application after a certain period has passed. In Alabama, this period is generally 2 years from the policy's issue date. For example, if a policy was issued on January 1, 2023, and the insured dies on February 1, 2025, the insurer generally cannot contest the claim due to application misrepresentations, even if they later discover one. This clause provides assurance that once a policy has been in force for the specified time, it will not be challenged for past application inaccuracies. Question 5. What is the typical grace period for a life insurance policy in Alabama? A. 7 days. B. 15 days. C. 30 days. D. 60 days. Answer: C. 30 days. The grace period is a stipulated amount of time after the premium due date during which a policy owner can still pay the premium without the policy lapsing. In Alabama, the standard grace period for a life insurance policy is 30 days. This means if a premium payment is missed, the policy remains in force for an additional 30 days, providing a safety net for the policy owner. For instance, if a premium is due on January 1st and isn't paid, the policy will still be active until January 31st, allowing the policy owner to make the payment and avoid termination. Understanding this period is crucial for preventing unintentional policy lapses. Question 6. All of the following are common dividend options for participating life insurance policies, except A. Cash payment. B. Reduction of premiums. C. Purchase of paid-up additions. D. Conversion to term insurance. Answer: D. Conversion to term insurance. Participating life insurance policies, typically whole life, pay dividends to policy owners, which are a return of unused premiums based on the insurer's experience in mortality, interest, and expenses. Common dividend options include receiving cash, applying dividends to reduce future premiums, allowing them to accumulate at interest with the insurer, or using them to purchase paid-up additions to the policy, small, single-premium whole life policies. Converting to term insurance is a policy feature or rider, not a dividend option. Always remember that dividends are not guaranteed and are not considered taxable income until they exceed the premiums paid. Question 7. What is an insurable interest in the context of life insurance? A. The financial rating of the insurance company. B. The potential for the policy owner to benefit from the insured's continued life or suffer a loss from their death. C. The amount of interest the policy's cash value earns. D. The insurer's right to invest premium dollars. Answer: B. The potential for the policy owner to benefit from the insured's continued life or suffer a loss from their death. Insurable interest is a fundamental principle in insurance, requiring that the policy owner would suffer a financial or emotional loss if the insured died. This interest must exist at the time the policy is purchased, but not necessarily at the time of the insured's death. For example, a spouse has an insurable interest in their partner, and a business often has an insurable interest in a key employee. This principle prevents people from taking out policies on individuals simply for speculative gain, thereby preventing moral hazard. Question 8. In Alabama, which of the following is required for a producer to sell variable life insurance products? A. Only a valid Alabama life insurance license. B. Only a securities license, example FINRA Series 6 or 7. C. Both a valid Alabama life insurance license and a securities license. D. A property and casualty license. Answer: C. Both a valid Alabama life insurance license and a securities license. Variable life insurance policies are unique because their cash value fluctuates based on the performance of a separate account, which consists of investments like stocks and bonds. Due to this investment component, these products are considered securities as well as insurance. Therefore, in Alabama, a producer must hold both a valid life insurance license issued by the Department of Insurance and a securities license, such as a FINRA Series 6 or 7, to legally sell variable life insurance. This dual licensing requirement ensures that agents are knowledgeable in both insurance principles and securities regulations. Question 9. Which rider would provide an insured with a portion of the death benefit while still alive, typically if diagnosed with a terminal illness? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Accelerated, living, benefits rider. Answer: D. Accelerated, living, benefits rider. The accelerated, living, benefits rider allows a policy owner to receive a portion of the policy's death benefit while the insured is still alive, usually upon diagnosis of a terminal illness that is expected to result in death within a specified period, example 24 months. This benefit is designed to help the insured cover medical expenses or improve their quality of life during a difficult time. For example, if an insured with a $500,000 policy is terminally ill, this rider might allow them to access $250,000 immediately, with the remaining $250,000 paid to beneficiaries upon death. It provides financial relief when it's needed most. Question 10. A policy owner in Alabama allows their whole life insurance policy to lapse but wishes to reinstate it. Which of the following conditions is typically required for reinstatement? A. The insured must undergo a new medical exam, regardless of policy lapse duration. B. All overdue premiums plus interest must be paid. C. The policy must have been lapsed for less than 1 year. D. The policy owner must purchase a new policy instead. Answer: B. All overdue premiums plus interest must be paid. The reinstatement provision allows a policy owner to restore a lapsed policy to its original form and benefits. To reinstate a policy in Alabama, typically within a specific time frame, often 3 or 5 years, the policy owner must pay all back premiums with interest, repay any outstanding loans, or the loan balance plus interest will be reinstated, and provide evidence of insurability to the insurer. The requirement for a new medical exam depends on the insurer's underwriting rules and the duration of the lapse, but paying overdue premiums and interest is always fundamental. Reinstatement is generally more cost-effective than purchasing a new policy, as it retains the original issue age and potentially better premium rates. Question 11. Which of the following best describes stranger-originated life insurance, STOLI? A. Life insurance policies sold to individuals who are not U.S. citizens. B. Life insurance policies purchased by investors who have no insurable interest in the insured, primarily for the purpose of selling the policy to a third party. C. Life insurance policies issued without the insured's knowledge or consent. D. Life insurance policies where the beneficiary is a charitable organization. Answer: B. Life insurance policies purchased by investors who have no insurable interest in the insured, primarily for the purpose of selling the policy to a third party. Stranger-originated life insurance, STOLI, refers to arrangements where investors initiate life insurance policies on individuals with whom they have no insurable interest, solely for the purpose of selling the policy to third parties in the secondary market. This practice is considered illegal and against public policy in Alabama and most other states because it violates the principle of insurable interest and creates a moral hazard. For example, an investor might pay an elderly person a small sum to take out a large policy, naming the investor as beneficiary or immediately assigning the policy to them. Regulators view this as speculative and exploitative, emphasizing that life insurance is meant for protection against loss, not for investment schemes. Question 12. If a life insurance policy's cash value is used to take a policy loan, what is the consequence if the insured dies before the loan is repaid? A. The loan is forgiven, and the full death benefit is paid. B. The loan amount, plus any accrued interest, is deducted from the death benefit paid to the beneficiary. C. The policy is automatically converted to a term policy, and the death benefit is reduced. D. The beneficiary is responsible for repaying the loan. Answer: B. The loan amount, plus any accrued interest, is deducted from the death benefit paid to the beneficiary. A policy loan allows a policy owner to borrow money from the accumulated cash value of a whole life policy. These loans are not subject to credit checks and do not have a fixed repayment schedule. however, they do accrue interest. If the insured dies before the policy loan is repaid, the outstanding loan amount, along with any accrued interest, is deducted directly from the policy's death benefit before it is paid to the named beneficiary. For example, if a $100,000 policy has an outstanding loan of $10,000 plus $500 in interest, the beneficiary would receive $89,500. This ensures the loan is repaid without affecting the insurer. Question 13. Which type of life insurance policy is known for offering flexible premiums and flexible death benefits, and its cash value grows based on interest rates set by the insurer? A. Whole life. B. Term life. C. Universal life. D. Variable life. Answer: C. Universal life. Universal life insurance is a type of flexible premium adjustable life insurance that allows policy owners to vary their premium payments and death benefits within certain limits. Its cash value grows based on an interest rate declared by the insurer, which can fluctuate over time but usually has a guaranteed minimum. Unlike whole life, it offers more flexibility in managing premiums and benefits, and unlike variable life, its cash value growth is not tied directly to market performance. This flexibility makes it a popular choice for those whose financial needs may change over time, allowing them to adapt the policy as needed. Question 14. An agent replacing an existing life insurance policy in Alabama must fulfill certain obligations. Which of the following is not typically an agent's responsibility during a replacement? A. Provide the applicant with a notice regarding replacement. B. Obtain a list of all existing life insurance policies to be replaced. C. Submit the notice regarding replacement and the new application to the replacing insurer. D. Advise the applicant to immediately surrender the existing policy. Answer: D. Advise the applicant to immediately surrender the existing policy. Replacement regulations are designed to protect consumers by ensuring they are fully aware of the potential disadvantages of surrendering an existing policy to purchase a new one. An agent's responsibilities during a replacement in Alabama include providing the applicant with a written notice regarding replacement, obtaining a list of all existing policies being replaced, and submitting these documents to the replacing insurer. Advising an applicant to immediately surrender an existing policy is generally considered unethical and potentially harmful, as it might lead to a loss of coverage during the underwriting period for the new policy or forfeiture of valuable benefits. Always emphasize the importance of retaining the existing policy until the new one is fully in force. Question 15. If an insured commits suicide within 2 years of a life insurance policy's issue date in Alabama, what will the insurer typically pay? A. The full death benefit. B. The accumulated cash value only. C. A reduced death benefit determined by the insurer. D. A refund of the premiums paid. Answer: D. A refund of the premiums paid. Most life insurance policies include a suicide clause, which states that if the insured commits suicide within a specified period from the policy's issue date, the insurer's liability is limited. In Alabama, this period is typically 2 years. If suicide occurs within this timeframe, the insurer will generally only refund the premiums paid, without interest, to the beneficiary. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide shortly thereafter. If suicide occurs after this 2-year period, the full death benefit is paid. Question 16. What is the main purpose of a viatical settlement in life insurance? A. To allow a policy owner to sell their life insurance policy to a third party for less than its death benefit but more than its cash value, typically due to a terminal or chronic illness. B. To allow an insurer to settle a life insurance claim without a named beneficiary. C. To facilitate the sale of life insurance policies on the secondary market for investment purposes by healthy individuals. D. To provide funeral expenses for the insured upon their death. Answer: A. To allow a policy owner to sell their life insurance policy to a third party for less than its death benefit but more than its cash value, typically due to a terminal or chronic illness. A viatical settlement allows a terminally or chronically ill policy owner to sell their life insurance policy to a third-party buyer, a viatical settlement provider, for a percentage of the policy's face value. The amount received is less than the death benefit but typically more than the policy's cash surrender value. This provides the policy owner with immediate funds to cover medical expenses or other needs during their lifetime. For instance, someone with a $200,000 policy might sell it for $120,000, giving them access to funds they wouldn't otherwise have. It's a way for individuals facing a shortened life expectancy to liquidate an asset. Question 17. Which of the following statements about group life insurance is true? A. Individual underwriting is performed for each member of the group. B. Certificates of insurance are issued to individual members, while the master policy is issued to the group sponsor. C. Group life insurance typically has cash value that can be borrowed against. D. Premiums for group life insurance are usually higher than for comparable individual policies. Answer: B. Certificates of insurance are issued to individual members, while the master policy is issued to the group sponsor. Group life insurance is a single policy covering many people, typically employees of a company or members of an association. With group life, the insurer issues a master policy to the group sponsor, example the employer, while individual members receive a certificate of insurance, which serves as proof of their coverage under the master policy. Individual underwriting is generally not performed, as the group is underwritten as a whole, and group policies typically do not accumulate cash value. Premiums for group life are usually lower than individual policies due to the economies of scale and broad risk pool. Question 18. Under what circumstances would the proceeds of a life insurance policy typically be included in the insured's gross estate for federal estate tax purposes? A. If the beneficiary is a minor. B. If the insured possessed any incidents of ownership in the policy at the time of death. C. If the policy is a term life policy. D. If the premiums were paid annually. Answer: B. If the insured possessed any incidents of ownership in the policy at the time of death. For federal estate tax purposes, life insurance proceeds are generally included in the insured's gross estate if the insured possessed any incidents of ownership in the policy at the time of their death. Incidents of ownership refer to any economic rights in the policy, such as the right to change the beneficiary, surrender or cancel the policy, assign the policy, or make a loan against its cash value. For example, if an individual owns a policy on their own life and dies, the death benefit will be included in their estate. To avoid inclusion, ownership is sometimes transferred to an irrevocable life insurance trust or another individual, ensuring the insured holds no economic control. Question 19. An Alabama licensed producer must always remember that advertising and marketing materials used to promote life insurance products must be: A. Approved by the Alabama Department of Insurance prior to use. B. Truthful and not misleading in form or content. C. Standardized across all insurers. D. Written only by the insurer, not the producer. Answer: B. Truthful and not misleading in form or content. In Alabama, as in all states, insurance advertising and marketing materials are heavily regulated to protect consumers from misrepresentation. The fundamental requirement is that all materials must be truthful and not misleading in any way, ensuring that consumers receive clear and accurate information about policies and their benefits. While some specific types of advertisements or products might require filing with the Department of Insurance, the overarching principle is truthfulness. For example, an ad cannot imply that dividends are guaranteed or that a policy will provide immediate tax-free cash access without clear qualifiers. This ensures that the public makes informed decisions based on accurate information. Question 20. Which of the following statements regarding the misstatement of age or sex provision in a life insurance policy is true? A. The policy will be voided if the insured's age or sex was misstated. B. The death benefit will be adjusted to the amount the premium would have purchased at the correct age or sex. C. The premiums will be refunded, and the policy cancelled. D. The insurer will charge the beneficiary the difference in premiums. Answer: B. The death benefit will be adjusted to the amount the premium would have purchased at the correct age or sex. The misstatement of age or sex provision is a standard clause in life insurance policies that addresses situations where an applicant provides incorrect age or sex information. Instead of voiding the policy, which would be harsh, the insurer will adjust the death benefit to the amount that the premium paid would have purchased at the insured's correct age and sex. For example, if someone understated their age, they were paying too little premium, so the death benefit will be reduced. Conversely, if they overstated their age, they were paying too much, and the death benefit would be increased. This provision ensures equity for both the insurer and the policy owner. Question 21. What is the primary difference between level term life insurance and decreasing term life insurance? A. Level term has a fixed premium, while decreasing term has a fluctuating premium. B. Level term has a death benefit that remains constant, while decreasing term has a death benefit that declines over the policy term. C. Level term offers cash value, while decreasing term does not. D. Level term is renewable, while decreasing term is not. Answer: B. Level term has a death benefit that remains constant, while decreasing term has a death benefit that declines over the policy term. The primary distinction between level term and decreasing term life insurance lies in their death benefit structure. Level term insurance provides a death benefit that remains the same throughout the entire policy term, offering consistent coverage. Decreasing term insurance, conversely, has a death benefit that gradually declines over the policy term, often aligning with a decreasing financial need, such as paying off a mortgage. Both types typically have level premiums and do not build cash value. For instance, a 30-year decreasing term policy might start with a $300,000 death benefit but reduce each year until it reaches zero at the end of the term. Question 22. In Alabama, which of the following is an example of an unfair trade practice for an insurance producer? A. Explaining the features of a new policy to a client. B. Misrepresenting the terms, benefits, or advantages of an insurance policy. C. Providing a client with a business card. D. Assisting a client with a policy claim. Answer: B. Misrepresenting the terms, benefits, or advantages of an insurance policy. Unfair trade practices are prohibited actions by insurance professionals that are considered unethical or illegal and are regulated by the Alabama Department of Insurance. Misrepresenting the terms, benefits, or advantages of an insurance policy is a clear example of an unfair trade practice, as it deceives the consumer and can lead them to make an uninformed decision. For example, telling a client a whole life policy has guaranteed returns of 10% when it does not would be a misrepresentation. Producers are expected to act with integrity and provide accurate information at all times, upholding the public trust in the insurance industry. Question 23. What is the purpose of the waiver of premium rider in a life insurance policy? A. It allows the policy owner to skip premium payments for a year without penalty. B. It waives all future premium payments if the insured becomes totally and permanently disabled. C. It reduces the premium payment if the insured opts for a lower death benefit. D. It provides a return of premiums paid if the insured outlives the policy term. Answer: B. It waives all future premium payments if the insured becomes totally and permanently disabled. The waiver of premium rider is a valuable benefit added to a life insurance policy that protects the policy in the event of the insured's total and permanent disability. If the insured becomes totally disabled, as defined in the rider, for a certain period, typically 6 months, all future premiums for the policy are waived by the insurer for the duration of the disability. This ensures that the policy remains in force and continues to provide coverage even when the insured is unable to work and pay premiums. For example, if an insured becomes paralyzed, this rider would ensure their life insurance policy doesn't lapse due to inability to pay. Question 24. A policy owner names "my children" as the beneficiary of their life insurance policy without specifying individual names. If one child predeceases the policy owner, and the policy does not include a per stirpes designation, how would the death benefit likely be distributed among the surviving children? A. The deceased child's share would go to their heirs, example their children. B. The deceased child's share would be divided equally among the surviving children. C. The entire death benefit would be forfeited to the insurance company. D. The policy owner's estate would receive the deceased child's share. Answer: B. The deceased child's share would be divided equally among the surviving children. When beneficiaries are designated as "my children" without a specific per stirpes by the branch or per capita by the head clause, the distribution typically defaults to per capita among the surviving beneficiaries of the same class. This means if one child predeceases the policy owner, that child's share is equally divided among the remaining surviving children. In a per stirpes designation, the deceased child's share would pass to their heirs. Always encourage clients to be specific with beneficiary designations and consider primary and contingent beneficiaries to avoid ambiguity. Question 25. Which of the following statements about the taxation of life insurance death benefits in Alabama is generally true? A. Death benefits paid to a beneficiary are always subject to federal income tax. B. Death benefits paid to a beneficiary are generally received income tax-free. C. Premiums paid for individual life insurance are tax-deductible. D. Cash value growth is always taxable annually. Answer: B. Death benefits paid to a beneficiary are generally received income tax-free. One of the most significant tax advantages of life insurance is that the death benefit paid to a named beneficiary upon the insured's death is generally received income tax-free at the federal level, and typically also at the state level in Alabama. This means the beneficiary receives the full face amount of the policy without having to pay income tax on it. For example, if a beneficiary receives $500,000 from a life insurance policy, that money is typically not considered taxable income to them. This tax-free nature makes life insurance an extremely effective tool for estate planning and providing financial security.